Welcome to lecture number 22. In this lecture we shall discuss about profitability ratio. Let us start by looking at the profitability ratios. There are three types of profitability ratios used by bankers. 1. Net profit margin. This is given by net profit or profit after tax divided by net sales. 2. The second is EBITDA margin. This is calculated by EBITDA divided by net sales. 3. The third is cash accruals. Cash accruals are given by profit after tax, PAT, plus depreciation, D. Technically this is not a ratio, but this is an important measure of the profitability of a company. Please note, EBITDA is earnings before interest, depreciation, tax and amortization, calculated as profit after tax, PAT, plus interest, I, plus depreciation, D, plus tax, T, plus amortization, A. Please remember this formula as it will be used in many examples later. Let us start by look at an example for the calculation of the ratios. In this example, MSXYZ Limited is a chemical manufacturing company. The exhibit shows the P&L and the balance sheet as on the 31st of March of 2016. Please note the figures for each of the P&L and balance sheet items. Let us calculate the profitability ratios. We will start with the calculation of the net profit margin. The P&L statement and the balance sheet of MSXYZ, as on the 31st of March of the financial year, is shown here. Please note the items on the expenses and income side of the P&L account. On the expenses side of the P&L statement. 1. PAT, depicted by profit transferred. 2. Taxes. 3. Finance charge, which implies the interest on loan. 4. Depreciation. The sales figure is provided in income side of the P&L statement. For calculation of the net profit margin ratio we do not require any inputs from the balance sheet. Let us calculate the net profit margin for financial year 2014-15 and 2015-16. We know, net profit margin equals net profit divided by sales. For financial year 2014-15, net profit or PAT equals Rs 40 lakhs and for 2015-16, PAT equals Rs 53 lakhs. Net sales for 2014-15 equals Rs 300 lakhs and for 2015-16 equals Rs 390 lakhs. Thus net profit margin ratio for 2014-15 equals Rs 40 lakh, divided by Rs 300 lakhs equal to 13.33%. The net profit margin ratio for 2015-16 equals Rs 53 lakh, divided by Rs 390 lakhs equal to 13.59%. Note, the banker shall interpret this calculation of net profit margin as, for net profit margin, the higher the ratio, the better it is. So in this case, between 2014-15 and 2015-16, the company has done better in 2015-16. Gross profit margin or operating profit margin can. Let us calculate the EBITDA margin. We know EBITDA equals PAT plus depreciation plus interest plus taxes plus amortization. From the expensed side of the P&L statement, we have PAT, depicted by profit transferred, taxes, finance charge, which implies the interest on loan, and depreciation. There is no amortization considered in this example. On the income side of the P&L statement, the sales figure is provided. For calculation of the EBITDA margin we do not require any inputs from the balance sheet. Let us calculate the EBITDA margin for financial year 2014-15 and 2015-16. EBITDA margin equals EBITDA divided by sales. For financial year 2014-15, EBITDA equals PAT 40 lakhs plus taxes 10 lakhs plus interest 12 lakhs plus depreciation of 10 lakhs, equal to Rs 72 lakhs. For financial year 2015-16, EBITDA equals PAT 53 lakhs plus taxes 15 lakhs plus interest 15 lakhs plus depreciation of 20 lakhs, equal to Rs 103 lakhs. Net sales for 2014-15 equals rupees 300 lakhs and for 2015-16 equals rupees 390 lakhs. Thus EBITDA margin ratio for 2014-15 equals rupees 72 lakh divided by rupees 300 lakhs equal to 24%. The EBITDA margin ratio for 2015-16 equals rupees 103 lakh divided by rupees 390 lakhs equal to 26.41%. Note: the banker shall interpret this calculation of profit margin as the performance in year 2015-16 is better compared to 2014-15. The improvement in EBITDA margin has been better. Now we shall calculate the net cash accrual. The net cash accrual is technically not a ratio, but it is used along with the profitability ratios. The net cash accrual is given by the formula, net cash accrual equals PAT plus depreciation. Please note, all the figures are available on the expense side of the P&L statement. From the P&L statement, we have PAT for 2014-15 as rupees 40 lakhs and depreciation as rupees 10 lakhs. Thus net cash accrual for 2014-15 equals rupees 40 lakhs plus rupees 10 lakhs, equal to rupees 50 lakhs. Similarly, net cash accrual for 2015-16 equals rupees 53 lakhs plus rupees 20 lakhs, equal to rupees 73 lakhs. The banker shall interpret this as cash accrual for 2015-16 is better compared to 2014-15. Please note the following about the profitability ratios. In case of profitability ratio, we should follow the following logic. 1. If the profitability ratio is showing improvement, we have to see whether this is happening with increased sales. The sales may be increasing on account of increased volume or increased price per unit or both. 2. If it is price increase, we have to ask questions about strategy of the borrower to address the issue if price. Let us now look at the interpretation of the profitability ratios in details. Based on the calculation and the observations from the profitability ratio, the banker must delve deeper and ask questions to get satisfactory responses from the borrower. This will help in progressing the credit process further. Banker must know the questions to be asked for analysis of profitability ratios of the borrower. Let us look at the situation comparing net profit margin and EBITDA margin across multiple financial years. We will interpret the observations and then look at the questions that the banker must ask. In case 1, the net profit margin and EBITDA margin has both increased across the years. The interpretation of this is: improvement in profit margins can be for the following reasons. A. Increase in price. B. Increase in volume coupled with a reduction in costs. This is preferred over the point A. Cost reduction such as fixed cost or variable cost. C. Increased efficiency. The banker must ask the borrower the following questions. 1. Is the growth price or volume driven? 2. If price driven, how will the price drop be handled? 3. If volume driven, is that sustainable and supported by capacity? 4. Can the reduction in cost, in any way, negatively impact the future business? Is the borrower ignoring long-term benefits for immediate gains? The banker will require the borrower to provide for a satisfactory response to progress the case. Click Next to continue. In case 2, both net profit margin and EBITDA margin has shown a significant increase, which means it is much above industry peers and the other companies. The interpretation of this for the banker is that the significant increase has to be supported by strong reasons, as this can also be due to 1. Fake sales reporting. 2. Relationship-based business, where a sudden spurt in projects from existing customer can increase business volumes significantly. The banker must ask the borrower the following. 1. What is the reason for such stellar performance? 2. Is the sales verifiable to a satisfactory extent? 3. Is the growth sustainable? Let us look at more cases of interpretation of the profitability ratios. In this slide we shall look at the observations on net profit margin and EBITDA margin for more situations. In the first case discussed here, the net profit margin has increased year on year, but the EBITDA margin has shown a decrease for the corresponding years. The banker must interpret that operating profit is going down, but other income is generating profit. We have to determine whether the decrease in operating profit is a one-time phenomenon or a permanent one. If it is going to continue, there is a problem. The banker must ask the borrower the following questions. 1. What is the reason for the decrease in operating profit? 2. What are the steps taken to address the reasons for such a decrease? The response to the questions received from the borrower shall help the banker to take the case further. Click the next button to continue. In the second case here, the net profit margin has decreased year on year, but the EBITDA margin has shown an increase in the corresponding years. In this case, the banker shall interpret by determining which non-operating expenses are bringing the profitability down and if these are recurring in nature. The banker must ask the borrower the following questions. 1. What are the reasons for an increase in non-operating expenses? 2. What are the steps taken to address the same? The questions asked by the banker is a significant activity which shall help in prudent lending by the bank. Thank you for watching this lecture.